Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first private credit giants Ares and Apollo freeze withdrawals amid market chaos as traditional safe havens like gold and US Treasuries plunge. We'll explore how this breakdown in safe assets and stress in private credit signals a potential stagflationary regime shift for investors. Second, Mexico and Spain's successful price controls defy free market orthodoxy, sparking a global debate on greedflation and political intervention risk. Today, we'll take a closer look at this clash between political populism and economic orthodoxy and its implications for investors in stable sectors. Third, India slashes diesel tax to zero in a high-stakes gamble, causing its 10-year bond yield to surge amid stagflation warnings. We'll analyse why this massive fiscal transfer matters now and how it could affect India's sovereign credit risk and global capital flows. A single social media post from US President Donald Trump just sent trillions of dollars in financial assets into a tailspin. After Trump claimed very good and productive talks with Iran, oil prices plunged more than 10% and global stocks rallied. But the market whiplash didn't last. The power of the post is now dwindling. As we discussed a while back when we looked at how markets react to presidential posts, there's a clear trend of diminishing returns. Researchers tracking the market's reaction have found that traders are now pricing in what's called a credibility discount. Essentially, the market's initial shock, often measured by the volatility index or VIX, is getting smaller with each announcement. This suggests that the president's ability to influence markets with words alone, a tactic known as jawboning, is becoming less effective. Following a second announcement extending deadlines, the market's reaction was muted. Brent crude is now surging over $108 a barrel, and the tech-heavy Nasdaq has officially slipped into correction territory. Continuing our last discussion on choke points being weaponized, that surge in Brent is exactly the kind of escalation the IEA warned would become more and more severe without a swift resolution. But that's not the whole picture. The situation on the ground tells a different story. While the president claims Iran asked for a reprieve, the Wall Street Journal cites mediators who say no such request was ever made. The US is reportedly still looking to send an additional 10,000 troops to the Gulf, even as Tehran rejects a 15-point US proposal. This geopolitical tension has deeper long-term implications because the disruption to dollar-denominated oil trade could significantly accelerate the rise of the petro-yuan. This means more oil transactions between China and its suppliers could be settled in Chinese yuan. We previously analysed how a prolonged Middle East supply shock could split global energy markets, one priced in US dollars and another centred on a Russia-China axis, especially as China, a major energy importer, prioritises energy security and ramps up alternatives. Today's shift toward yuan settlement is the concrete expression of that risk, not just a theoretical talking point. This geopolitical drama is unfolding while other cracks appear in the financial system. Private credit giant Ares management has been forced to cap investor withdrawals after a spike in redemption requests, a major red flag for a sector already on edge. So the thing is, when funds like Ares and Apollo cap withdrawals, it's known as putting up a redemption gate. This is a mechanism to stop a flood of investors from pulling their money out all at once, which could force the fund to sell its assets at fire sale prices. It's considered a lagging indicator of severe portfolio stress. Experts are concerned this geopolitical shock could be the catalyst for what's called a Minsky moment in the opaque private credit market. That's a sudden collapse after a long period of accumulating risky debt. A freeze up here could trigger a much broader credit crunch. What's really catching strategists off guard, though, is how traditional safe havens are breaking. Gold has weakened since the crisis began, and even US Treasuries are softening, forcing a total rethink of what a safe asset even is. This breakdown reveals a potential regime shift. Typically, during a crisis, investors rush to buy gold and US government bonds for safety. But this time, it's different. The current shock is stagflationary, meaning it brings both economic stagnation and rising inflation from high oil prices. A while back, we flagged how a sustained energy shock forces households to re-budget cutting travel and hospitality, even as overall inflation stays high, and how airfare, a visible CPI line item, can blur the signal for policymakers. That's exactly the kind of mixed data that complicates central bank decisions and it's why authorities had already been preparing for a drawn-out disruption. This all begs the question, what's the real end game here? While Wall Street tries to price in a potential war, the president's gamble that America's oil wealth would shield the economy from a shock is being put to the test. So where do we go from here? First, keep an eye on credit markets. The actions at funds like Ares and Apollo are a warning shot. Any further signs of a freeze-up could signal a broader economic slowdown. Second, watch the behaviour of gold and bonds. If they continue to fall together during stress, it confirms this new stagflationary regime is here to stay. Finally, for our listeners in China, it's crucial to monitor the share of oil trade being settled in yuan as a leading indicator of a long-term currency shift. And tying back to our earlier focus on household rebudgeting, also watch the airfare component of CPI and jet fuel inventories for early reads on whether the crunch is easing or deepening. And the American public seems to have a verdict. A recent Reuters Ipsos poll shows only 29% of the country approves of the president's handling of the economy, the worst rating President Trump has ever received on this issue. Speaking of governments grappling with economic shocks, some are taking a radically different and surprisingly successful path. While many are failing to tame inflation, two major democracies did the unthinkable. They brought back price controls, and it worked. In Mexico, the government capped the price on a basket of 24 essential goods, from chicken to toilet paper. In Spain, the government responded to the cost of living crisis with a national rent freeze and even made many train tickets completely free. Now, while these measures can provide immediate relief to households, they also create unintended consequences for global trade. For instance, a policy like Mexico's price cap can disrupt what economists call arbitrage. Normally, if a product is cheaper in one country and more expensive in another, traders buy it cheap and sell it for a profit, which helps balance prices. But with a price cap, it might no longer be profitable for international companies, including those in China or the US, to export their goods to Mexico. This could lead to future shortages, testing the resilience of global supply chains. The result? Both governments were decisively re-elected, with the ruling party in Mexico boosting its vote share from 55 to 61%. This flies in the face of 4 decades of economic orthodoxy that says politicians should never meddle with prices. Actually, this isn't a new playbook. In the 1970s, the US government under President Nixon also implemented widespread wage and price controls to fight inflation. While it seemed to work at first, the long-term result was market distortion, underinvestment, and eventually crippling shortages and a period of economic stagnation. So the critical question now is whether today's economies are different enough to avoid repeating that history. This is where the situation takes a more complex turn, revealing a massive conflict playing out in other economies. Take the United Kingdom, a long-time laboratory for privatisation. A recent analysis by the think tank Commonwealth calculated that since the 1990s, the country's privatised utilities have paid out almost £200 billion to shareholders and private equity. This has fueled a powerful narrative that economists are now calling greedflation, or profit-led inflation. This happens when companies use the cover of general inflation to raise their prices far beyond their actual increase in costs, boosting their own profit margins. The European Central Bank has noted this exact pattern in essential sectors, which shifts the blame for inflation away from central banks and directly onto corporations. This has prompted leaders like Manchester's Mayor Andy Burnham to declare that privatisation is the root cause of today's cost of living crisis. He's not alone. In a major policy reversal, Manchester has already started renationalising its bus network, bringing routes back under public control. At the same time, major privatised companies like Thames Water are in deep financial distress, facing credit downgrades that signal a crisis in the private utility model. Calls to follow Spain's example are growing louder, with some politicians even advocating for a wider price reset and nationalising key industries. The central power struggle is now clear. The long-held belief that only markets should set prices versus a growing global movement demanding government intervention. The upshot is that persistent inflation on non-discretionary spending is now becoming a leading indicator of political risk. It can force even the most pro-market governments to adopt policies they would have previously considered unthinkable, creating what investors call a political intervention risk premium on supposedly stable assets like utilities. This isn't just theory. It's a high-stakes battle with re-elected governments on one side and £200 billion in shareholder payouts on the other, the central trade-off is now clear. In the short term, these interventionist policies can deliver political victories and price stability, but the lagging indicator could be a decline in investment and future supply shortages. For investors, this means even traditionally safe sectors like infrastructure now carry a new, unpredictable political risk. For a major exporting nation like China, a trend of widespread price controls in other countries could disrupt trade flows as those markets become less profitable to sell into. As the success stories in Mexico and Spain ripple across the globe, the pressure for other nations to abandon the free market experiment may soon become too strong to resist. That debate between intervention and free markets is playing out in real time elsewhere. In a high-stakes defensive move, India just took the drastic step of slashing its tax on diesel all the way down to zero. This isn't a minor policy tweak, it's a defensive maneuver in a global energy war. The Indian government is essentially making a high-stakes choice between controlling short-term inflation and maintaining its long-term fiscal health. By cutting taxes, it's prioritising immediate price relief for its citizens, but this gambles with its own budget. If high oil prices continue, this could widen the fiscal deficit and even risk a sovereign credit downgrade. With conflict in Iran sending international crude prices through the roof from around $70 a barrel to $122 a barrel, New Delhi has made a choice: sacrifice revenue to protect its people from surging prices at the pump. Petroleum and Natural Gas Minister Hardeep Singh Puri admitted the government is taking a huge hit to its tax revenues, cutting duties on both petrol and diesel by a full 10 rupees per litre. This is more than just a tax cut. It directly transfers the financial burden of the price shock from consumers and companies onto the government's own balance sheet. That's why India's sovereign bond yields, which reflect the market's confidence in the government's financial health, are now a more critical indicator to watch than even the stock prices of oil companies. We've already seen the yield on India's 10-year government bond climb to a 16-month high, signalling that investors are growing concerned, and the pain isn't just in the government's budget. The country's state-run oil companies are now absorbing staggering losses of around 30 rupees for every single litre of diesel they sell and 24 rupees per litre of petrol. This is a deliberate, massive subsidy to keep the economy moving. This direct, on-the-book subsidy is a fascinating contrast to how other major economies are handling the pressure. By comparison, China's approach to energy security is often more state-led and less transparent, relying on its vast strategic petroleum reserves and directing its state-owned enterprises to absorb costs, but without such a clear public price subsidy. This sets up a real-time test of which model can better insulate a large economy from a protracted energy crisis. And the shockwaves are already hitting the broader market. HSBC's latest data shows India's private sector activity just slowed to its lowest level since October 2022, with companies directly citing unstable market conditions and intense inflationary pressure. Now get this, that data point, the Purchasing Managers Index or PMI, just fell below the critical threshold of 50. A reading below 50 indicates economic contraction. This is the first hard data suggesting that the energy shock is creating stagflationary conditions, that toxic mix of high inflation and slowing economic growth. An analyst at S&P Global warned that the longer the energy disruption persists, the higher the structural risks to the economy. This all points to a high-stakes gamble with billions on the line. One forecast from Renaissance Investment Managers suggests that if oil prices settle between $85 and $95 a barrel after the war, it could trigger outflows of up to $50 billion, more than 1% of the nation's GDP, and potentially slice India's economic growth from 7.2% down to 6.5%. The situation boils down to a few key indicators. First, keep an eye on India's 10-year bond yield as a real-time gauge of fiscal stress. Second, watch where global crude oil prices settle, as that will determine how long this painful policy must last. And third, look for the next round of PMI and inflation data to see if the threat of stagflation is becoming a reality.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.